Body. Our content is intended to be used and must be used for informational purposes only. It is very important to do your own research analysis before making any investment based on your personal circumstances. You should take independent financial advice from a professional in connection with or independently research and verify any information that you find on our website or podcast and wish to rely upon, whether for the purpose of making an investment decision or otherwise. What's up, my future one percenters? This is Marathon Money, brought to you by Wincrease.com. I'm Cam Jones, Prince of the Stock Market, and I'm with myself, man. Kenny Coins could not make it today, so it's just me. So first, you know how we do it. We're gonna get into a little bit of stock market recap, and this past week, obviously, did we hit new highs? No, we did not hit new highs, but we did come close. Now that last trading day, which was on Friday, we saw a little bit of a hit, but overall, we had a good week last week. And Kenny and I, we've been talking about that a little bit on the podcast because, we don't understand why, everyone gets in a panic a little bit when the stock market might drop, 500 or 1,000, because that's not really a lot when it drops that much on the Dow, at least. That's not really a lot. That's not anything to panic about. And I guess I'll speak for myself. I feel like this earnings season coming up is going to push this market to new highs. Now, it's not going. I don't think it's going to blow past the highs that were currently set, and go like 35,000 or something like that. I don't think so. I think we may be at about 29. But overall, if you look at the trend of the market on each, the NASDAQ, the Dow, and the S&P, everything's still trending up, at least on the yearly chart. And that, we're far away. I get worried when things are closer to the 200-day moving average. And right now we have a lot of space between the 200-day and where we're at right now. So I'm pretty happy about that, as far as a, uptrend goes on the market. And like we've said, a lot of times on this podcast, I start to get worried, not really get worried, but I start to buy up when the market goes down towards the 200-day. Now, if it's below it, I kind of, I'm a cautious buyer. But if it's sitting there hugging a 200-day, being indecisive around that 200-day, I'm buying up because I know it's going to move up. It likes to stay way above the 200-day or way below the 200-day. And, since we're in an uptrend, just use your common sense about it. We in an uptrend.
Use your common sense.
We in an uptrend. Right? So start buying up. And every time that has happened, you hear, the doom and gloomers talking about recession and everything like that. And me and Kenny, Marathon Money, we buying up. And then every time this happens, every time we talking to you either close to highs again or at new highs, we're talking to you about, what we bought. We glad we bought this here when everybody was scared or whatever. Now, one day, it's going to burn us because the market doesn't go up forever. It will go down at some point, so one time when it hugs that 200-day and, I'm buying up, I'm going to get burned one of them times. I will get burned one of them times because the market will not make its move back up. It'll go down, because that's just how the market is. Stock market up, stock market is down. That's how it's always been. That's how it's always going to be. It's never going to go up forever. It's always going to drop, and it's never going to stay down forever. You just have to be prepared for that and kind of look for the signals, look for the signs, so that I guess I'm talking to you about me preparing myself for when I do get burned. Um, Basically, what I would do is, if I see it drop, if it's hugging the 200 day and it makes a big drop below it, I'm looking at getting out. I probably won't get out of all of my positions, but I'll end up, shrinking my positions and then trying to play the swings, to get out of even more, because, as it drops, it may go up, it may drop, 1,000 one day, it may go up 200 another day or something like that. I may try to play the swings that way, or you could get put options and make your money that way, while the market is going down. But that's for when that time comes. Right now, that time is not here, so I'm still gonna keep doing whatever I'm doing. You should keep doing whatever you're doing, because if you're in the stock market right now, you're making money. You're making money, so don't change what you're doing. We're still in a uptrend, way above the 200 day, and it's earnings season, and that's kind of what the main topic is today, is earnings season and how to play it. So we got some heavy hitters coming up this week that's reporting earnings. But there's only how many? There's only 3 you should worry about if you're playing options, because if you're playing options on earnings, you want there to be a massive move in order for you to make some money on earnings week. If you're playing options on a certain stock that's reporting that week. Now you can make money if it's flat. So let's just take, for instance, Twitter. Twitter is reporting on Thursday, the 24th. So Twitter usually doesn't move that much on earnings. You may see, like, a $3 move, $4 move. Sometimes, it doesn't move anywhere on earnings. And obviously you can't buy a call or a put on that, because, it's going to eat your option premium. And, for everybody out there who doesn't, understand the option lingo, we're not going to, or I'm not going to get into explaining what everything is about options, what everything means about options. I would suggest that you Google it, because somebody else can explain that better than I can. I'm terrible at explaining options, as you can see if you listen to some of our older podcasts from about a year and a half ago or so. Yeah, I'm pretty terrible at that. But if you purchase a call or put on something like Twitter, that doesn't really have a good history of making big moves on earnings, then you're basically just giving your money away. The option premium is just going to wash away. But for something like Twitter, you could play. I think it's you could sell the options and then take the option premium that way. But I'm not gonna get into that. That's complicated. What we're gonna focus on is just playing the heavy hitters that move, $15 to $50 on earnings, that have a history. That doesn't mean that they will move that much on earnings, because they can be flat on earnings. But we talk about ones that we know have a history of moving big, so your chances are better at making money on call or put options. So the first heavy hitter coming up on Tuesday, October 22nd. That is Chipotle, CMG. So they usually move about they're good for about a $30 move on earnings. And so what you'll see is on earnings week when these certain stocks start to are about to report earnings, you'll see the option prices get ridiculous. I'm talking about they get crazy. So if you play Chipotle options on a regular basis, on a let's say you were playing it 2 weeks ago, hold on, where's CMG at right now? Okay, they are sitting at $841. So let's say you were buying a Chipotle option 2 weeks ago that ended that strike week, the same strike week you were playing it. Let's say you bought a $850 call. That $850 call option probably would have been somewhere around $500, $600. But now, since it's earnings week, that $850 call option is $2,525. Now, why is that? That's because it's earnings week. So they know, the market knows that this week there's going to be some money that could be made. There's some big swings. Like I said, Chipotle is good for a $30 move. So you'll see the option prices get out of whack. Now, that's for the naked option. If you're not, doing any option spreads or anything to limit your risk. So what happens is most people, they really don't want to pay. And I don't want to pay $2,500 for, a call option on Chipotle either, because that's a lot of money to lose if it does not go up. So what you can do is buy a vertical spread to limit some of that risk right there. And like I said, man, you want to try to look up these things, what a vertical option spread is. Look that up on Google so you can get a better understanding of it. Like I said, you don't want me explaining this stuff. You'll be very confused if I explain it. I know how to do it. Explaining it, that's a different story. So let's just take a look at what a vertical call option is for $850 strike. Now, if you bought an $850 to $852.50 call option for this week coming up, that is $70. Now, I am looking at this after hours, so by the time the market opens tomorrow, it will change. But I'm just trying to give you an example. I'm just trying to compare to you on earnings week what a vertical spread will cost you versus a naked. Now, the good thing about the naked options are you can make unlimited money. There's no limit. So if Chipotle went from $841 to $2,000 this week, you're gonna make like a ton of money if you had an $850 call for this strike week. Now with a vertical, you're not. You're limited into the amount of money that you can make. And it's basically based on how many vertical options you buy. So let's say you bought one, and I'm not going to try to do the math here. If you bought one $70, $850 call, $850 to $852 vertical, and Chipotle went up to $2,000, you're probably the maximum that you can profit. And I'm just guessing here, just throwing out numbers. The maximum that you could profit would probably be like $100 because of how vertical spreads are set up. But like I said, man, you want to make sure that you look that stuff up yourself. It'll make sense. If you don't understand it, when you look up vertical spreads and how they are basically compiled, it'll start to make sense to you. But enough of that. We talk about the heavy hitters that's coming up this week. So like I said, the first one coming up is Chipotle. They're sitting at $841. And like I said, just from the research that I've done, they're good for about a $30 move. That doesn't guarantee a $30 move. I'm just saying, if you wanted to buy some verticals, the farther you go out, the cheaper the vertical is going to be and the more money that you can make. So, if what I'm saying is, if it's a $30 move, if they're good for a $30 move, if you put your trust in me, if you trust me and you trust my research, what you would say is, okay, it's $841 on the day that they report. If it's still $841, obviously it's not going to be. But for the sake of this conversation, we're going to say that it is. What you would do is you would say, okay, it's about a $30 move. I want a 867.50 to $870 vertical spread on the call side, because I'm saying that they're good for a $30 move, which means that I think that they are going to go up $30 after earnings. So you don't have to buy the 850 because that's only about $10 away. You get the, 870, somewhere around 870. And that right now is $40. And you'll profit more on that because it has more, it's covering more range basically. So that's what I mean by, it's good for a $30 move. Now that's on the high side, so that's a little bit risky right there to do that. If it were me playing it and I'm saying that, hey, it's good for a $30 move and it's $841, I may go up to a $860 just to give me that $10 cushion, just in case it does not go up 30, because that's not guaranteed. I'm just going based off of past earnings, what they usually do. And I do think overall this earnings season is going to be good. So if it were me, I would buy the call side. But you can also play both sides, the call and the put side. It's a little bit complicated. It's more complicated than what I want to get to on this show. I mean, if we talk about all this stuff, man, it'll be, a 2-hour show, man. Y'all be over here sleeping. But we just gonna. I think that the market will be up, so we only gonna do the call side. But if you think that Chipotle is going down, I mean, by all means, you can make money like this on the put side also. I'm just talking call side, but this can be applied to the put side also. So that's enough about Chipotle. Let's get to the second heavy hitter this week. My boys Tesla. Shout out to Jerron. I know he will probably buy put options on Tesla for earnings this week. Now Tesla, they report on Wednesday, October 23rd. And that's aftermarket. You always want to check to see if they report aftermarket or before market, because if you play in options, if they report before options, let's say that Tesla reports Wednesday before market opens, then you need to make sure you have the options on Tuesday before the market closes. If you don't, then you miss it. You miss the move. Now they report Wednesday on the 23rd after the market closes, so you can buy the call options or whichever options you want to buy. You can buy them on Wednesday before the market closes. Now let's get to Tesla. Tesla is good for about a $15 move. So basically, let's see where Tesla is at right now. Tesla is $256.95. Let's just call it $257. Tesla's at $257. They good for a $15 move. So what I'm saying is, and you really have to calculate this from Wednesday when they are about to close, when the market is close to closing, maybe about 3 o'clock or so. But let's just act like, we're going off of this number, this closing number from Friday, which is 257. $15 move from 257. That is 60. That's 272. So what I'm saying is, if it were to report earnings from this number, 257, the max that they would go up is to $272. And Tesla, I feel like Tesla could do that pretty easy, up or down. I mean, I'm just like I said, I'm playing the call side, but this also works for the put side. Also, it's just a move. You don't matter where it moves, you just need it to move. Um, I mean, it matters if you have call or put option. If you have a call, obviously you need it to move up. If you have a put, obviously you need it to move down. But for me, I would get the call. And so how I would play that, since it's a $15 max move, how I would play that is I would go up $10 on Tesla, which would mean I would get somewhere like probably a two. Let's see what they have here. A 267.50 to 270. And right now, as of this recording, that is a $90 vertical spread, which is, I feel like that is pretty reasonable. That's a pretty cheap price. Now, obviously, when the market opens, as it gets closer to Tesla reporting, you're going to see these prices fluctuate. It's probably going to go up a little bit more. This will realistically probably be $115, $120 vertical spread. But, I mean, that's still far cheaper than, let's look at what the naked is for a 270 call. 270 call, $518 right now. So that is a lot cheaper. If you ball in on a budget, you want to get the vertical spreads. If you ball in on a budget like me, you get the vertical spreads because you're not risking that much money. So that's Tesla. And the last heavy hitter that's reporting this week is Amazon. Now, you all know, I don't even have to tell you about Amazon. Amazon go hard. They go real hard. And I really feel like this earnings season for Amazon is going to be big because I think they're going to have big projections for Christmas. Now, after Christmas, we talk about that after Christmas earnings season right now. I don't really think that's going to be that good because I really feel like I don't feel like people are broke in this economy. I feel like people are just smarter on what they spend their money on. If you think about it, and I won't stay on this topic for too long, but if you think about it, man, kids, when I was a kid growing up, because I'm an old dude, when I was a kid growing up, I used to want, a bunch of toys and stuff like that. That's why people like Toys R Us and things like that, they were thriving. But, now with a bunch of electronics and things like that, kids, they don't really want that stuff. They want, an iPhone or they want an iPad, something like that. And that really fills that void of toys, because they like to mess around with the screen more than they do to play with the toys. Some kids do like to play with the toys, but what I'm saying is electronics have changed the game with how people purchase, presents, basically, because kids, they don't want that stuff anymore, I mean, they want it on an impulse buy. You see a commercial and you see, some kids playing with some Nerf guns and they knock down a building or something like that. Yeah, you want it, but realistically, you don't want it. You only want it because it was a good marketing campaign. Really, what you want an iPhone or something like that. So, but we won't stay on that. Amazon, I think, is going to do good. Now, where's Amazon right now? They are sitting at $1,757. Now, from my research, Amazon is good for a $50 move. I've seen Amazon go up over $100 before on earnings, but on average, they good for a $50 move. That's a safe play. So, we looking at, if you trusted that, you looking at either, getting a vertical around $1,800 on the call side or $1,700 on the put side, because that's about $50 away. I mean, if you want to play it real safe, you may want to go $30 out, $25 out if you want to play it real safe. But I think Amazon, out of all three of these that I mentioned, Chipotle, Tesla, and Amazon, if you had to play only one for the big move, it would be Amazon. Amazon is almost always moving big on earnings. I've seen Tesla go flat on earnings a bunch of times. I've seen Chipotle go flat. Not a lot, but I've seen it go flat before. I don't think I've ever seen Amazon flat after earnings. I mean, they always moving. Watch, somebody will tell me it was flat like last earnings or something like that. But nah, man. Um, Amazon is the other one that you want to get, and let's say you do the same thing. You check um your strike prices for a vertical option for about maximum $50 out. If you playing $50 out, I still think out of all three, like I said, I think 50. If you played the maximum out, Amazon will be the one that you want to play the max out with the $50 move. Chipotle, obviously we said that's a $30 move. You may want to go $20, $15 out to be safe. Tesla, you may want to go about $10 out to be safe. But Amazon, they're good. They're good for the move. I really feel like they are good for the move of 50, probably even more. But you want to go out. So let's see where since I'm bullish. So let me see where the $1,800 call is. A naked call. How much is that costing for Amazon right now? Hold up. They got a ton of strikes. $1,800 naked is about $2,000 for this strike week. Now let's check out a vertical spread. And we're gonna check out a $1,800 to $1,802 vertical spread. That's $113. It's $113. So you can you can get in these options, man. Don't think that because the naked option is $2,000 for one call. Don't think that you can't play it. You can get creative with the options and the option spreads, and you can play it. So just think about that. Remember, Chipotle this week, Tesla this week, Amazon this week. Oh, let me get you the days again, because I didn't lost them. Chipotle Tuesday, October 22nd. Tesla is Wednesday, October 23rd. Amazon is Thursday, October 24th. All reporting after market. So if you wanted to play options, those I think would be the safer plays if you're looking at a big move. If you're trying to play that earnings will be flat, you don't want to play those because those usually always move. You want to play something like a Microsoft or a Twitter or something else if you're looking for stocks that don't move that much on earnings. So that's all I got today. You can follow me on anything: Instagram, Twitter. I forgot what stock twits. Whatever. My name is always the same. Camboni11. CAMBONI11. Hit us up on Facebook. Like our Facebook page. We have a Wincrease page and also a Marathon Money page. Like both of them. And hit me up, hit any of us up, and ask to join our Facebook chat. We have a private Facebook chat that we just throw around trade ideas. There's a lot of smart people in there, man. A lot of people making some money, man. Shout out to my boy Rich. My boy Rich, who's in the chat, man. He shorted Netflix, making that marathon money. Good looking out, Rich. Who else in there? My boy Abu in there. He balls out a lot. My boy Lou. Shout out to my homie Lou. There's a couple other people in there I know I'm forgetting. I probably shouldn't say names because I forget a lot, and then people get mad if you don't shout them out. But my boy Matt, he in there. Everybody in there, man. There's a lot of smart cats in there that's making some money. Not just off of our stuff, but just on their regular stuff too, and they share what they're doing. And also you can support the podcast by cash apping Marathon Money on the Cash App. Shoot us, some beer money or something like that, even though I don't drink. shoot us something on the Marathon Money Cash App. The cash tag is Marathon Money, all one word. We're also getting set up with PayPal and Venmo, so we can have different ways that people can donate. So people have been wanting to support the podcast, but they don't have Cash App. So we're just trying to get that all set up so people can help out, show your support to Marathon Money, man. Shout out to my boy Kenny Extro Jerron. We got a new segment coming up, hopefully next week, called Short Report. Jerron will be doing that. If you've been in our Marathon Money chat, then you've heard about that. We're going to start that up next week. So shout out to my boy Jerron, man. And I'm running a little late. So, peace.